So you just bought a house, but you had to bid higher than the list price to get the deal, and you're a little worried about the appraisal coming in. So I want to talk about 4 different things that you can do if your appraised value comes in lower than your sales price. If you want to learn more about this, please watch my video. So when you buy a home and you get a mortgage, your mortgage is based on the lesser of your appraised value or your purchase price. In most cases, in normal times, it's going to be your sales price because generally the appraised value is matching this, sometimes even a little bit higher. But as the market has become extremely competitive, we're seeing people buy homes for much higher than the actual list price of the home, which can make appraisals come in a little bit lower because they're not keeping up with the pace of the appreciation in the market. So there's a few things that you can do, and I'll run through an example of numbers so that you can follow along. But first, some options. One, if you did not waive your appraisal contingency, you can just walk away. You will want to talk to your agent about this because you may or may not lose your earnest money, but this is one of your options. Another thing that you can do is renegotiate with the seller to lower the purchase price down to the actual appraised value. A lot of times they're reluctant to do this, of course, as you can imagine. You can also renegotiate, you can split the difference, but you can also change your down payment percentage. So how this would work in a situation where you bought your home for $700,000 with a 20% down payment, you would, in your original situation with 20% down, you would be expecting to do a $140,000 down payment. But let's say your appraisal comes back and it comes in at $650,000. Now your loan amount is going to be based on 20% down of the $650,000, and that would be $130,000. But you have to make up the difference if you didn't renegotiate with the seller, and then you would need to pay the extra $50,000 to the seller for the agreed upon purchase price. So that would be $180,000. What you can do is change your down payment percentage to 15% down based on your appraised value. This is just on paper for the loan. It's not necessarily for the seller because you would still be giving the seller their purchase price. How this plays out in math world is with a purchase price or an appraised value of $650,000, 20% of that would be $130,000. Now you pay your $50,000 amount to the seller in addition to that 20% to come up with the full purchase price, and you would have a $180,000 down payment. You can change the percentage of down payment to 15%, which would be $97,500. Now you still have to pay the $50,000 shortage that on the appraisal, so that would mean the total of those two, your official down payment would be $147,500. So $7,500 more than what you were planning to do in the beginning, but it's a lot less than $50,000. You could also change your down payment percentage to 10%. And since this is just based on the appraised value, then it's just on paper. So how this would work is that on $650,000, your down payment of 10% would be $65,000. You still have to pay $50,000 for the shortage to the seller. That would mean your your down payment out of pocket would be $115,000, which is actually less than you were planning to pay on a $700,000 purchase price with 20% down. So the drawback to this is that you would then have to pay mortgage insurance. However, mortgage insurance can be a lot less expensive than a lot of people think. If your credit is good and you're a strong borrower, we call you borrowers, then on the 15% down payment, your mortgage insurance monthly could be as low as $60 a month. You can also opt to pay mortgage insurance all at once out of pocket. And so this can be another option to look at. That would be added to your closing costs, and so it would increase your out of pocket costs, but it's a lot less than $50,000 for the straight shortage. If you did 10% down, of course, that monthly amount for the mortgage insurance would be up a little bit more because it's a little bit higher risk. So, but it would not be $50,000. So I just want to make sure that you guys have the information that you need. If you have any questions on this, please reach out.